Interest rates represent the cost of borrowing money or the return on investment for saving. They are typically expressed as a percentage and are applied to loans, mortgages, credit cards, and savings accounts. The level of interest rates in the economy is influenced by central banks, economic growth, inflation, and various other factors. Key concepts related to interest rates. 1. Nominal versus real interest rates. Nominal interest rate, the rate advertised by financial institutions, not adjusted for inflation. Real interest rate, the nominal rate adjusted for inflation, giving a more accurate picture of the cost of borrowing or the return on investment. Real interest rates are important for making financial decisions because they reflect the actual purchasing power of money over time. 2. Fixed versus variable interest rates. Fixed interest rate remains constant throughout the life of a loan or investment, providing predictability in payments or returns. Variable interest rate fluctuates based on changes in the economy, often tied to a benchmark rate, such as the Federal Reserve's rate. Choosing between fixed and variable interest rates can significantly affect borrowing costs and investment returns, depending on the economic environment. 3. Central bank influence. Central banks, such as the Federal Reserve in the U.S., set benchmark interest rates that influence the rates banks charge customers. Lower rates encourage borrowing and spending, while higher rates discourage it and aim to control inflation. Understanding this dynamic is key to evaluating macroeconomic policies in finance assignments. How to approach interest rate topics in finance assignments. A. Understand the economic context. When tackling assignments that deal with interest rates, it's important to understand the broader economic context. Are rates rising or falling? What are the inflation expectations? These factors will influence the conclusions you draw. B. Use relevant formulas. For assignments that require calculations, ensure you use the appropriate formulas, such as the Fisher equation, for adjusting nominal rates to real rates or WACC when analyzing corporate finance decisions. C. Analyze scenarios. Interest rates can affect different stakeholders in various ways. Be sure to analyze how interest rate changes impact consumers, businesses, and governments. Discuss multiple scenarios, such as rising versus falling interest rates, to demonstrate your understanding. D. Apply theories to real-world examples. If your assignment allows, reference real-world examples of how interest rates have influenced major financial decisions, such as government fiscal policies, corporate bond issuances, or stock market movements. Need help with your finance assignment? At financehomework.help, our experts can help you master complex financial concepts like interest rates and provide comprehensive support in completing your assignments. Visit our ordering page to get started today.